Hello everyone, this is Mohammed Akif with Akif CPA, and today we'll be talking about tax traps for Canadians with US LLC on E-2 and L-1 visa. So this is a series of vlogs. There are about 8 tax traps that we're discussing. This is the first series of those 8. I have another whole blog on the summary of those 8 tax traps. So in this tax trap, we'll be talking about the first one. What are the problems? Why the problem occurs, the root cause, and what is the solution? All right. So again, if you are a Canadian who's looking to move to the United States on an E-2 or L-1 visa, reach out to us to avoid this trap. info@akifcpa.com, info@akifcpa.com, to make sure that you understand how tax rules work on both sides, how taxes are done on both sides, what are the reporting requirements, and plan accordingly. It is important for you, your business, that you plan properly. Otherwise, what you're looking at is double taxation, misreporting, fines, penalties, additional taxation in some cases, and a lot of the mess that it will become is hard to clean. All right. So reach out to us, info@akifcpa.com, to avoid this tax trap that I'm about to discuss, and then look at the solutions too. So let's get to it. I'm going to share my screen with you so you can see what I am seeing. All right. So here we go. Not the window. Let's just share the first one. All right, so this is the first of the 8 traps that we'll be discussing today. We'll discuss why this is happening, right? And then the solutions to this tax trap. Okay, so let's get into it. All right, so for a Canadian, I'll put it out there very simply. There's a whole bunch of stuff that goes on. I want to talk about, for a Canadian, why this is a problem, and then how this problem occurs. So this problem occurs for multiple reasons, and then this is technically an advisor problem. I call it a blind spot, advisor blind spot. And what that technically is that U.S. attorneys, when you're going to them, they're giving you a simple. Their job is to get you the E-2 and L-1 visa, right? That's their job. And then so what they do is that they recommend, hey, get an LLC. That's the quickest, the safest, the easiest way to get an E-2 L-1 visa. And that's what you follow. Nothing wrong there. But what they don't understand is that there's a whole other side to this equation, which is the Canadian side. And I'll share with you what is happening and why US LLC creates double taxation. I'll go through some examples, and you will see what I am talking about. All right, let me share the other. So this is the advisor blind spot matrix that we have created. As you can see, let's zoom in. So US immigration attorneys, their job is to secure you the E-2 visa. They will tell you, hey, LLC is the best way, quickest way, the safest way. But they're not understanding that this can lead to double taxation on the Canadian side. They have no idea about this. They don't know about the reporting requirements for a non-US person, a non-US tax resident with a 100% ownership of a US LLC. There are penalties for those forms, $25,000. Secondly, is that a local US accountant, when you talk to them, they're dealing with majority of times domestic Americans, local Americans. They have no idea about the tax-free US and Canada tax treaty. They have no idea about the Canadian RRSP, Canadian TFSA, Canadian RESP, Canadian ETFs, Canadian mutual funds. No idea. how to report them, how does the federal taxes them, how does the state taxes them, and then they might go for the X corp election. A horrendous idea. All right. Local Canadian accountants don't know where to report the US LLC. Majority of them will report them on T1135, missing the whole point of T1134. There's a separate form that needs to be filed. Don't understand the tax treaty benefits, the Canadian US tax treaty benefits. Do not understand the substantial present rules on the US side. Have no idea how the reporting will be. So these are all the problems a Canadian go through. So because of these issues, because of three advisors not knowing, it's not that they intentionally don't know, they just don't know. Not knowing how this works leads you to in a dangerous spot where we have penalties, misreporting, fines, additional taxation, double taxation. And then we'll talk about today why there's a double taxation on the US LLC. So you can see what is happening. Let me bring back my blog. All right, so we talked about why this is happening. The root cause is that these advisors don't know how the cross-border taxation works. They have no idea how the US LLC gets taxed on the Canadian side and what kind of problems does it create. So we'll touch on the first problem, which is the double taxation problem. And so what is the double taxation and how is this happening? So I'll go through an example with you so you can see what we're talking about. Okay, so why there's a double taxation? So the way this works is that the US LLC on the US side is considered a disregarded or pass-through entity. Big, legal, fancy words. All right, you don't need to understand them. The only thing you understand them is they're taxed. A US LLC is taxed just like a sole proprietorship. Just like in Canada. If you have a sole proprietorship, you report on your T1. Same thing on the US side. It's considered a sole proprietorship. That means even though US LLC is a legal entity, it is separate from you. For tax purposes, it's considered as you are considered as one. So whoever owns the US LLC, for tax purposes, that person, that company, will have to report all the revenue, the expenses, the income from that LLC. The LLC does not file its own taxes. The person that owns it files taxes. And that's the reason it's called pass-through or disregarded. Disregarded means that you disregard the legal side of it for tax purposes and you report everything. Now, how is that a problem? That's a problem because the Canadian side does not consider this to be a pass-through, a disregarded entity. CRA considers a US LLC a corporation. So there's a mismatch right away. Disregarded, pass-through, Canada, corporation. Okay. And number two, the timing mismatch of the income. And I'll go through the problem of what is happening. You can see some of the examples. You can look at the math and then really make sense of what is going on here. So let's go through one of the examples, right? So let's assume $1 US is equal to $1 Canadian dollar. I wish this was back in probably 2011, 10, probably at that time, or where it was Canadian dollar, it was equal to US dollar. But for this example, we're going to take it as. So LLC profit the first year is 100,000, right? LLCs distributes 0. First year profit, 100,000, distributes 0 money. So you leave all the money in the LLC account. Number two, distributes 75,000 of the income. You pay yourself. We're assuming the US tax rate is 30%, and we're assuming the Canadian tax rate on the foreign dividend is 40%. All right, so let's look at it in actual math, how this is playing out. All right, so first year, what we're looking at is USC income, 100,000. It is a pass-through, right? Taxed immediately because again, the LLC does not pay any taxes. The person that owns, or the company that owns the LLC, pays the taxes, right? So US taxes were 30%. Now you owe $30,000. For Canadian side, they're looking at this as a corporation. So when a corporation earns money, the corporation pays the tax. So for Canadian side, what they're saying is the corporation has earned zero money because corporation hasn't filed any taxes, right? No dividend received, and Canadian tax is going to be zero. Because the Canadian tax is zero, there is no FTC, foreign tax credit. Now you have paid, in the first year, you have paid $30,000 to the US, to the IRS. All right, so let's go to year 2. So year 2 happens now. And year 2, you can see we have 10,000 taxable income. This is just for example's sake. And then there was a distribution of 75,000 in the second year. All right, so what happens with that 75,000? Because CRA considered this as a corporation. And so now this is technically considered a dividend. So how is the US looking at the 75,000? First, for US, because the LLC is disregarded or a pass-through, that distribution, that dividend of that from 100,000 is not taxable anymore. The assumption is the person has already paid taxes on it. So there's no additional taxation to be done here. Whereas Canadian side, they're looking at this as a dividend, just like a Canadian corporation. And they're saying that we're going to tax you on that dividend. This is what is happening. So now, the second year, we have we have taxable income on the Canadian side of dividend, which is 75,000. There's no tax that we have paid on 75,000 in year 2. So no foreign US taxes to offset any Canadian taxes. And then you end up paying 30,000 to the CRA on the dividend. Right? What happens? In total, you have paid 60,000. Your effective rate becomes 60%. Understand, this is double taxation. You have already paid 30,000 on 100,000 of income before in year 1. In year 2, now you're paying 30,000 on the 75%, 75,000, which is the 40% tax rate. Crazy stuff. You cannot utilize. So only time this is happening is when there's a mismatch. Now let's talk about the solution. How can we solve this, right? Let's talk about how can we solve this issue. We can solve this issue by having this LLC being taxed as a corporation on the US side. So there's a form called 8832. And then once we file that form, we convert that tax status of the LLC from disregarded, from a pass-through, to a corporation, which is similar to what Canada has. Canada is recognizing this LLC as a corporation. Now US is recognizing this as LLC as a corporation. Corporation on both sides. Now let's talk about how what same numbers, if both were corporations, how this income will be reported and how the taxation will happen. Right? So let's go to number, for example, 2, same scenario. So now, because now this is a US corporation, US rate is 21% flat for the federal rate. I'm not talking about state taxes here, only the federal taxes. And then again, the dividend rate is 40% that we have said before. All right, so year 1, same thing, right? Year 1, same thing. 100 LLC earned 100,000. There's a corporate tax on 100,000, which is 21%. Good. There's no income, no dividends, nothing there, nothing to be done on the Canadian side, just like what we did with the previous example. No foreign credits because we haven't paid any taxes, and then 21,000 is what we're paying to the IRS. Okay, let's go to year 2. In year 2, company distributes 79,000. We have a 15% tax treaty rate, they get applied. The only tax we're paying is $11,850. Same $79,000 is being reported because it's a dividend to the person that owns the corporation. Right? In case same dividend gets reported on the Canadian side. The tax on the Canadian side is 40%, which is $31,600. We get the foreign credit of $11,850, which leaves us at $19,750 Canadian tax. In this scenario, we are able to fully utilize the U.S. tax paid on the dividend, which is $11,850 on our Canadian side, which lowers the effective tax rate below 60% that we had previously. I think it's 70%, so previously was 70%. So we can see only $19,750 is due to the CRA. And then by claiming foreign tax credit on $11,850 that you paid to the IRS, the US IRS. All right, so this is what I am talking about. US LLC double taxation, if it's considered a disregarded or sole proprietorship or a pass-through. And then how can you make that a better scenario? By switching it to a corporation on the US side. Only on the US side, you make it as a corporation. And you are able to match the taxes of that LLC the same on the Canadian side and the US side. All right, so this is first series of number 8, tax traps for Canadians with US LLC on E-2 and L-1 visa. If you have any questions, shoot us an email at info@keepcpa.com. If you're looking to move, looking to buy, looking to set up a new business in the US, we can help you with the guidance, with the tax planning, and then so you can make better decisions. Email us info@keepcpa.com. Thank you.